Everything's a good idea if it's cheap enough, and everything's a bad idea if it's too expensive. In this lecture, we'll examine how the equilibrium models that we developed previously can be used to determine if something is too expensive or too cheap. We'll explore how to do this in 3 steps. First, we need to examine short selling in greater detail than we did earlier in the course. This first step is important because shorting allows an investor to exploit mispricing when a security is overvalued. The second step is to develop a framework in which you can take the implications of an asset pricing model and apply it to securities in the market to identify mispricing. The result of the second step is to develop a measure of mispricing called alpha. The third step entails using information about a stock's alpha and its idiosyncratic volatility to form an optimal risky portfolio that exploits mispricing without taking on too much risk. Okay, so let's get started. Step 1 is to examine how to short. The overriding idea of the lecture is everything is a good idea if it's cheap enough, and everything's a bad idea if it's too expensive. As it turns out, this statement is not completely accurate for investments because, as we'll discuss next, you can actually make a gain if the price is too high. In order to do so, however, you're going to have to be able to take a short position in a security. A short position is when you sell a security that you don't own. How do you do that? Well, first you have to borrow it, then you sell it. At some point in the future, you have to return it, which you do by going back into the market and buying it back at whatever the market price is then. Another famous saying, of course, is buy low, sell high. A short position lets you make money by reversing the order. Sell high, buy low. Let's consider another Sleesco example. You think Sleesco is currently too high at $20 per share and expect it to fall over the next 6 months. If you currently own Sleesco, you could benefit from this knowledge just by selling it now to avoid the loss. But if you didn't own it, you could make money by shorting it. Borrow 1,000 shares from someone and sell them at $20 per share to get $20,000. With that money, you can invest it in something else in the meantime. Let's say you invest in short-term T-bills and you get 1% per annum, and after 6 months, your $20,000 will grow to $20,100. During that 6 months, the true value of Sleesco has become apparent to the market and now trades at $10 per share. You close out your short position by buying the 1,000 shares back for a cost of $10,000. And you pocket the difference between the $20,100 and the $10,000, that's $10,100. So even if something is too expensive, it may still be a good idea if the idea is to short it. Of course, shorting might turn out badly. If the price of Sleesco were to rise to $30 per share, you'd have to buy back those 1,000 shares for $30,000. In that case, you have paid $30,000 to have the use of $20,000 for 6 months. That's not a good deal. Essentially, you paid an effective interest rate of 125% per annum. That is, you paid the rate R such that $20,000 equals $30,000 discounted back at 1 plus R for half a year. That's R equals 125%. The way to think about a short sale is that on average, you are borrowing money at the expected return for that security that you borrowed. For example, if the expected return on Sleesco was 8% per annum, then on average, the price of Sleesco would have risen at that rate for 6 months, from say $20 to $20 times 1.08 raised to the half power, that's $20.78. So if you short 1,000 shares at $20, you have the use of the $20,000 for 6 months. When you close out your position, on average, you'll have to pay $20.78 per share for a total cost of $20,780. Thus, you borrowed $20,000 for 6 months and paid it back by paying back the original $20,000 plus interest of $780. That is an 8% interest per annum. So you can use a short sell to either speculate on a drop in price or just to borrow money. But you need to realize that when you short sell via an online broker, you may need to use what is known as a margin account. In that case, you may be borrowing just to be able to borrow by shorting. Let's work through an example. Let's say you have an account at a broker that has $20,000 in cash and $300,000 in securities. If you short 1,000 shares at $20 per share, then they will put $20,000 in cash into your margin account. This is so that if the price rises, you have no incentive to default and not return the shares. If the price rises to 21, then the margin account must have $21,000 in it. Since you only had $20,000 in cash, the broker will loan you $1,000 to bring the margin up to $21,000. But since the broker is lending you that $1,000, they're also going to charge you some interest. Thus, you'll be paying interest twice, once with the run-up in the stock price, and the second time on the amount that is needed to be put into the margin account that you may have to borrow. In addition to these costs, you should also realize that there may be a limit on the amount that you can short due to a lack of availability of shares to borrow. Also, sometimes after you have shorted, you may have to close out your position before you want to, before the price actually falls. Typically, when you short, you borrow shares from some other account at your broker's. In fact, when you open an account, you typically agree to allow the shares that you have to be lent to other customers of that broker. You will not care if they are lent out, since if the stock pays, say, a dividend in the meantime while it's lent out, the short seller must pay you the dividend. And if you want to sell the shares that have been lent out already, the broker will give back your shares and lend the shares out from some other account to the shorter. Thus, you really don't care if your shares are lent out at any point in time. There are times when no one is willing to lend shares anymore, since perhaps they all want to sell. In that case, you will not be able to maintain your short position. Once your broker cannot find shares to borrow, you will have to close out your short position, and that might be at a loss. The other problem with the short position is that you can lose more than your initial position. If you borrow $20,000 to buy 1,000 shares of Sleazeco and the price falls to zero, you've lost $20,000. But if you short it to $20 per share and the price goes to 100, you will owe $100,000 for an $80,000 loss. So you can lose a lot by shorting. Okay, now that we've seen what it means to short, we can examine what it means for a security to be mispriced. This notion will lead us to what is known as alpha. In general, an asset pricing model will tell you how to trade based on a deviation from the implications of that asset pricing model. We will consider some alternative pricing models in subsequent lectures, but for this lecture, we'll stick with CAPM since it is a single factor model. The fact that it's a single factor model actually simplifies things quite a bit and allows us to imagine this process a little bit more easily. Recall that CAPM says that the expected return for a particular security should exceed the risk-free rate exactly by the product of that security's beta with the market risk premium. Further, CAPM says that this should hold for all securities. So let's consider if you formed a scatter plot of the average return on the vertical axis against the beta on the horizontal axis. According to CAPM, the data should have an intercept at the vertical axis at the risk-free rate. That is, a security with a beta of 0 on the horizontal axis should, on average, return the risk-free rate of return. So let's say that this risk-free rate is 2.8%. Then for beta larger than 0, the average return should increase at a constant rate. The constant rate should be the market risk premium, i.e. the expected return on the market minus the risk-free rate. For concreteness, let's let this market risk premium be 6%. Thus, according to CAPM, all of the data should land on a straight line. This line is called the security market line, or the SML for short. If there's any security that does not lie on the SML, then that security is mispriced relative to CAPM. For example, consider Sleazeco. Let's say that the beta of Sleazeco is 1.2, and it has an expected return of 8%. According to the SML, a security with a beta of 1.2 should have an expected return of the risk-free rate of 2.8% plus the beta times the market risk premium. The second part is going to be 1.2 times 6% or 7.2%. So the total is 2.8% plus 7.2% or 10%. Thus, with an expected return of only 8%, Sleazeco is below the SML. The difference between the expected return and that predicted by the asset pricing model, CAPM in this case, is the alpha. In this case, the alpha of Sleazeco is 8% minus 10%, that's negative 2%. A non-zero alpha implies that the price of the security is not what it should be according to the asset pricing model. That is, given the cash flows expected for SleazeCo and the riskiness of those cash flows, the price should be those cash flows discounted at 10%. But the current price is discounted at 8%. Takes those cash flows and discounts them at 8%. Since the price would be lower if the cash flows were discounted at the appropriate 10%, the price of SleazeCo is too high with an expected return of 8%. Thus, SleazeCo might be a good candidate for shorting. So let's short it. If we just sell short, then we'll have what is referred to as a naked position. A naked position is one in which you don't have an offsetting hedge position in something else. If you just short, what might be the return? Recall that CAPM is a model that is consistent with the single factor model, where the single factor model is the market, where the single factor is the market return. That is, the market return is a sufficient statistic for all of the risk in the economy. The single factor model is the return on an individual security is equal to the risk-free rate plus its alpha plus its beta times the difference between the market return and the risk-free rate plus an epsilon for that individual security, an idiosyncratic term. For SleazeCo, we have a beta of 1.2 and we have an alpha of negative 2%, negative 0.02. If I take a short position in SleazeCo, the realized return can be any value that's consistent with the single factor model. What happens if, for example, the market soars on good news? Also, what about the idiosyncratic component? So let's say, for example, that the return on the market turns out to be 20% and the idiosyncratic return turns out to be negative 10%. Then what's going to be the realized return on SleazeCo? It's going to be, The risk-free rate of 2.8% minus the alpha of 2% plus 1.2 times what? The difference between the market and the risk-free rate, that's 20% minus 2.8%. And then we're going to subtract off the idiosyncratic term, add the negative idiosyncratic term of negative 10%. That gives us a return, a realized return of 11.44%. What would be your gains or losses from shorting in this case? Well, let's say that you shorted SleazeCo at $20. If the return over the next 6 months turned out to be 11.44, then the price of SleazeCo will have risen to what? 20 times 1.1144 raised to the half power, because it's 6 months. It would have gone up to $21.11. You would have lost $1.11 per share on, say, the 1,000 shares that you shorted. You lost $1,110. All right, so the problem here is that even though there was bad news about SleazeCo, the market went up by so much that it overcame the effect of the negative news for SleazeCo. The price rose and you lost on your short. Okay, so is there any way for you to avoid this? The answer is yes. What you want to do is you want to take advantage of a non-zero alpha by forming a portfolio that has a neutral beta. How about if there's another security that has the same risk as SleazeCo, but that lies on the CAPM line, that lies on the security market line? Let's consider a company, let's call it Price Right Inc. Let's let it lie on the line, and it's going to have the same beta as SleazeCo, but its expected return is going to be what's on the security market line. It's going to be 10%. Let's form a portfolio of SleazeCo and Price Right so that we can exploit SleazeCo's alpha, but neutralize its beta. Since Price Right will give us an average return of 10%, but SleazeCo only 8%, then that portfolio should be long Price Right and short SleazeCo. In fact, for every dollar that we go long Price Right, we will want to short $1 worth of SleazeCo. That is, sell $20,000 worth of SleazeCo short, and then use the proceeds to go out and buy Price Right. Okay, so what will we get? The return on Price Right over the next 6 months will depend upon idiosyncratic returns and also the return on the market according to the single factor model. The return on Price Right is going to be equal to the risk-free rate, 2.5%, plus its alpha, which is 0, plus 1.2, its beta, which is the same as SleazeCo, times what? The excess return on the market, the market return minus the risk-free rate, plus, let's say, epsilon for Price Right, the idiosyncratic term. I'm not sure what that's going to be. As before, the realized return on SleazeCo is going to be what? RS is equal to the 2.8%, the risk-free rate, minus 2% for its alpha, plus 1.2 times the excess return on the market in excess of the risk-free rate, plus whatever SleazeCo's idiosyncratic term turns out to be. Now, if we go long price right and we short SleazeCo, then the net return is the difference in these two returns. And so just do a little bit of algebra, and what you see is that the difference is equal to what? 0.02 plus the idiosyncratic term on price right minus the idiosyncratic return on SleazeCo, where the 0.02 is what? It's the alpha from SleazeCo. Thus, on average, since the idiosyncratic terms are on average 0 by market efficiency, you will get what? 2% returns, the negative of the alpha for the mispriced security, completely independent of whether the market goes up or down, right? So this strategy neutralizes market risk. And that neutralizes the market risk that we faced when we were just shorting SleazeCo alone. Now, there is some risk that remains here due to the idiosyncratic terms. Thus, the riskiness of this strategy depends upon the variance of these idiosyncratic terms. The greater this variance, the greater the possible deviation from 2% we will get over this horizon. Now, what if we can't find a security that has the same beta as the mispriced SleazeCo? Well, then let's form a portfolio of other securities that does. For example, let's consider True Value and Levmark. True Value has a beta of 0.7 and Levmark has a beta of 1.5. If you put X% into True Val and 1 minus X% into Levmark, what value of X will generate a portfolio with a beta of 1.2, the beta for SleazeCo? The beta of a portfolio is simply the weighted average of the individual betas, where the weights correspond to the fraction of the money invested in each. Thus, the answer to our question is the value of X that solves X times 0.7 plus 1 minus X times 1.5 equals 1.2. A little algebra implies that what? X is going to be 0.375. So put 37.5% in True Value and 100 minus 37% or 62.5% in Levmark. Then what? Use this portfolio of True Value and Levmark to fill in for price right. The whole strategy is to short SleazeCo. For every dollar received from shorting, put 37.5 of the proceeds into True Value and 62.5% of those proceeds into Levmark. What do you get at the end of the year? What you get is 2% plus what? This term that is the summation of a bunch of idiosyncratic terms. It's going to be 0.375 times the idiosyncratic term on True Value plus 0.625 times the idiosyncratic term on Levmark minus the idiosyncratic return on SleazeCo. So by the way, this is even a little bit better than what we had before because the variance of the idiosyncratic stuff will be partially diversified. That is, there's less variance in the idiosyncratic term of 0.375 times the idiosyncratic term on True Value plus 0.625 times the idiosyncratic term on Levmark minus the idiosyncratic return in SleazeAct because we formed a portfolio of the idiosyncratic part of True Value and the idiosyncratic part from Levmark. Okay, so we've just found what you do when you have found a non-zero alpha. But how do you find securities with non-zero alphas? All right, so this is the hardest part of investing. There are two approaches to finding non-zero alphas. The first is the result of the following process. Step 1, forecast cash flows for a particular firm. Either take analyst forecast or make your own based on your knowledge of the firm or their industry. Step 2, determine the riskiness of the cash flows. How sensitive are these cash flows to market movements? Step 3, calculate the discounted value of these free cash flows to determine the firm's value. Subtract off the estimate of the value of the debt to get the value of the equity. Think of this as the future value that will occur once the market reaches equilibrium. Think of it as where the ball ends up at the bottom of the bowl. Step 4, compare the value that you get in Step 3 with the current market price. If it's different, then guess at a horizon when you think the value from Step 3 will be reflected in the market. For example, if you think that it's worth $20 based upon a discount rate of 12% and the current value is $18, on a discount rate of 15%, then your alpha is going to be 15% minus 12%. That's going to be equal to 3%. That's your alpha. Okay, so you're going to have to wait to see when the price is actually reflected, but over that period of time, you're going to get an alpha of 3%. All right, the second approach is to run a regression of the return of the equity minus the risk-free return on the returns of the market minus the risk-free return. The constant in this regression is the alpha that we discussed last lecture. Use this alpha as your estimate of the returns in excess of what CAPM implies. All right, so as it turns out, both methods have problems. With the first method, it's hard to come up with good estimates of the firm's free cash flows. It's also hard to come up with how these cash flows are correlated with the return on the market to determine the correct discount rate to apply. Typically, what professionals do is they look at the required rates of return on the assets of other comparable firms. Note that I said that they look at the required rate of return on the assets of comparable firms, not the equity. They do this because they want to value the free cash flows of the whole firm. When they do that, they typically calculate the weighted average cost of capital for that firm. The weighted average cost of capital was discussed in lectures 12 and 13. With this estimate, they can then figure out what the present value of the cash flows are, and then once they get that value, they're going to subtract off the value of the debt to get the value of the stock. For the second method, you should realize that the alpha from a regression is the average value of mispricing. It may not be the alpha going forward. Let me explain further. The alpha is a return in excess of what CAPM implies. Thus, alpha is a degree of mispricing. In some periods, this mispricing may be big positive, but in other periods, it may be small negative. The alpha that you get from a regression is an average of the mispricing over the sample used to estimate the market model. As an average over the past sample, it may not be the alpha for that security going forward. In fact, alphas from regressions are notoriously bad. They're very noisy at the individual security level. Thus, both approaches are hard. So maybe this is why even professional fund managers can't beat their benchmarks on average. Okay, so we just examined how to find non-zero alphas. We also discussed, basically, how to exploit them. What we did not do is figure out what's the optimal way to hold them in an overall portfolio. In this next section, we'll examine the Traynor-Black model for active portfolio management. I must warn you, this model is very, very involved, but it does a couple of very important things. First, and most important, it provides a framework for thinking about how much your portfolio should be active and how much of it should be passive. Second, it gives you some explicit expressions for the magnitudes of the positions you should take with securities that you think have non-zero alphas. Let's first consider the framework. The framework admits that you may be able to beat the market by finding mispriced securities. If you could not find mispriced securities, then you should just hold a passive market portfolio. But if you can find mispriced securities, then you should not do what CAPM says. You should not just hold the market. Rather, you should supplement a passive position in the market with an active portfolio that consists of securities that you have found to be mispriced. Within this context, there are two things that you need to decide. The first is, what is the optimal active portfolio? That is, if you've done a bunch of analysis on, say, 10 securities and you've found 6 to be mispriced, what are the best weights to use in forming an optimal active portfolio on these 6 securities? All right, we'll see the answer to this in a minute. The second thing you need to decide is, given an optimal active portfolio, how much do I invest in that portfolio versus in the passive market portfolio? The question is, what is the optimal portfolio of these two portfolios, active and passive? Okay, so let's consider the first question. What's the optimal active portfolio? To form the optimal active portfolio, you need the alpha and the idiosyncratic variance for each mispriced security. For each security, take the ratio of the alpha to its idiosyncratic variance. Note that some of these ratios may be negative because the alpha for an overvalued security may be negative. Take all of these ratios and add them up. The weight for the ith mispriced security in the active portfolio should be its ratio divided by the sum of all the ratios. These weights seek to exploit the non-zero alphas, but at the same time, the weights reflect concern about idiosyncratic volatility in that security. Idiosyncratic volatility is a problem because there are typically too few securities in the active portfolio for the idiosyncratic returns to be diversified away completely. But a big non-zero alpha is good, but a big idiosyncratic volatility is bad. A security with an alpha that has a relatively large magnitude but has a small idiosyncratic variance should receive a much larger weight in the active portfolio. This process we just described creates such weights. Also notice that since some of the ratios may be negative, some portfolio weights will be negative. These may be securities that you're going to need to short. Once you have the weights for the active portfolio, you will need to determine the active portfolio beta, alpha, and the variance of the idiosyncratic components. The beta is just going to be the weighted average of the betas of the individual securities in this active portfolio. The alpha is just going to be the weighted average of the individual alphas for these same securities. The variance of the idiosyncratic components is simply the weight on each individual security squared times the variance of the individual's idiosyncratic variance, and then you add them up across all of the mispriced securities in the active portfolio. Remember that you can get the idiosyncratic volatility from the mean squared error in a regression for the specific security that is in the active portfolio. The active portfolio alpha, the beta, and the idiosyncratic variance are all used to answer the following question. What is the right weight to put on this active portfolio versus the weight to put on the passive portfolio? In other words, what's the right portfolio of the two portfolios? A first step in this process is to take the ratio of the active portfolio alpha, not the individual alphas, but the active portfolio alpha, the alpha for the whole active portfolio, take the ratio of that to the idiosyncratic variance of the active portfolio. Think of this ratio as the extra return, the alpha, per unit of idiosyncratic variance. If this ratio is not large, then the active portfolio would contribute little in terms of excess return, but contribute a lot in terms of idiosyncratic risk. If so, you want to put little weight or a little bit of money into that active portfolio. So let's call this ratio the expected return to variance ratio. You can also calculate a ratio like that for the market. Let this ratio be the expected return on the market divided by the variance of the market return. To see exactly how much to put into the active portfolio, you want to see how big the expected return to variance ratio is for the active portfolio relative to the ratio for the market. If this ratio of ratios is large, then you should put more in the active portfolio. If the ratio of ratios is small, then put in less. In some cases, by the way, the ratio of ratios will be negative. This means that you are going to want to short the active portfolio. And every now and then you're going to have some negative weights in the active portfolio. If you're going to short the active portfolio, a negative means that you're going to be taking on a long position in those securities. The intuition is that in order to exploit mispricing, you necessarily must take an undiversified position in securities that are mispriced. And when you do, you must bear the risk associated with those idiosyncratic returns. The amount that you want to put into the active portfolio should be bigger if the mispricing in these active securities is big relative to the amount of idiosyncratic risk these securities are going to expose you to. In subsequent lectures, we will examine some well-known violations of CAPM. These violations may give you some ideas where to look for mispricing, and when you find it, you can use the techniques developed in this lecture to optimize your portfolio return.